Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of New York and London coffee markets. I'll start with New York coffee. 3 weeks ago, the top side at that time was capped by the flat long moving average, currently 221.65, plus the 50% Fibonacci line of the August 21 to February 22 move at 217.45. I said at the time, and I quote, that should prices punch up and maintain levels over these, then the bearish halfway hesitation as well as the head and shoulders top and even the bearish Andrews pitchfork will all cease to be primary drivers of this market, and something else will have to take its place, end of quote. Well, something else did start 4 Wednesdays ago. A large bullish opening long white Mariposa that closed over both the 50% Fibonacci line at 217.45 and also the long moving average. Yet this move up was tempered, with prices subsiding back below the 50% Fibonacci line and long moving average. However, the market continued to harry and pressure the upside, enough that 3 Tuesdays ago, prices managed to push up not only through the long moving average, but also the short medium moving average, currently at 222.95. At the time, it was only the congestion at 227.60, 228.40 and 229.15 plus the overhead flatlining medium moving average, currently 229.30, that managed to contain a rise. Then 2 Wednesdays ago, the market made a further attempt higher, starting with a bullish engulfing pattern leading to a huge bullish long white Mariposa that shot up and closed over all the moving averages bar the medium moving average. This move up converted the head and shoulders pattern, the head and shoulders top pattern, to a head and shoulders continuation pattern. 2 Fridays ago, prices went further, pushing up and closing over the medium moving average and into a fairly free area that stretched up to at least the April high at 237.70 and eventually last week to the 2012 high at 241.05. It also saw the action of 2 weeks ago into a weekly key reversal up. Last week, we have seen prices rise and stumble at the 2012 high, but not as yet be finished with the bullish incentive. Today, we've seen the beginnings of another attempt higher, though it is more cautious than the one made last week. Beyond the high at 241.05, we next have the November 2011 high at 243.40. Then limited resistance, given the ammunition below, that has accumulated between March to May until the late February high and early December 21 high, both in the 252 area. Even then, that is not that strong a resistance. The question now is this: has the strong bullish incentive seen since May that's overcome so many resistances, does it still have enough to try that extra bit higher? Or is it enough to be in a free zone between the 241.05 high and the congestion below that starts from the flatlining medium moving average and stretches all the way down to the 50% Fibonacci line of the August 21 to February 22 move at 217.45? Let's see. If it does still have this bullish incentive, then I will start thinking about possible topside opportunities for a continuation head and shoulders pattern. London coffee. The key difference seen here in London compared to the New York contract is how the peak of the market was back in late December 21 rather than when New York had it in early February 22. This difference has been crucial to the early formation of a pattern here in the London contract much earlier compared to the New York contract. We have a November 21 to February 22 head and shoulders top. Admittedly, the first shoulder is split, but the action nevertheless stacks up as a legitimate pattern. The neckline is currently at 21.17. The market, which had broken down through it back in March, ended up unable to penetrate the support area underneath that stretches from the 20.04 level all the way down to the 19.35 area. In early May, prices made a strong attempt lower, making a new low not seen since August 21. Yet that achievement should be taken with a pinch of salt, as it was only a little lower compared to the low in early March. Nevertheless, it was worth noting that the primary target for this head and shoulders top had been achieved some while ago, and it was a secondary target that was enabled. And as I've often pointed out, secondary targets are harder to achieve. 3 weeks ago, the market started to develop intraday indecision with contrary patterns, one after another. This indecision seemed to have worked itself out, but then reasserted itself last 2 weeks ago and at the start of last week. However, last Tuesday, the market made a combined key reversal up and unusual bullish engulfing pattern. For starters, the market had a long tail, stretching all the way down to the interesting 50% Fibonacci line of the August to December 21 move at 2064. Additionally, it was also the first time we have had consecutive closes over the medium moving average since early May. However, what was unusual about the bullish engulfing pattern was how it was formed over a prior bullish pattern, in this case a counter to the counter bullish harami. In effect, it looked like an inverted descending hawk pattern. Most unusual. The outcome was that last Friday we had a move up through all the recent resistances. That is the neckline, the upper tine, currently 2114, over the February to May bearish shift pitchfork, the 2021 congestion, and especially the combination of the Fibonacci congestion at 2139, plus the short medium moving average, currently also 2139, actually finishing at 2139 on Friday. I should say last Wednesday, because it wasn't a full week. Well, today we've opened up lower on the 2021 congestion, but we've punched higher, almost as high as the overhead long moving average, currently 2164. But we've since stalled and dropped back to the same 2139 level. As I said last week, and I quote, all these are now under threat, as we seem to have built up a significant support and ammunition zone that stretches all the way down to just short of 2000. We have the possibility now of a March to date double bottom as well, or at least a possible rectangle pattern. End of quote. Question now is, will the market follow through with this pattern and move higher? The next resistance beyond the long moving average is the August 2017 high at 2173 and the July 2017 high at 2177. Now, the longer the market waits, the more likelihood will be that the rising long moving average will rise up enough to reinforce these two levels. And that could be the least to prove a halt to any rises for a little while. And at worst, it can prove to be a cap on the rises. Hence, what happens in the next few days will become, I suspect, quite crucial to any opportunities for furthering the bullish incentive. So watch carefully. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Invest Services International Limited. And here comes the final bit.